Hey guys, Omar here, broker and CEO for Alden Mortgage and Ome Realty. So this is going to be your mortgage rate update. Currently we're sitting at 425 2022 and it actually is looking better. We're actually doing a little bit better today. We finally got some good news. So we're going to be pricing out 5 different mortgaging products: the 30-year fixed, the 15-year fixed, the 30-year FHA, 30-year jumbo, and a 5/1 adjustable rate mortgage. And if you don't know what a 5/1 adjustable rate mortgage is by now, it is interest only fixed for 5 years and then adjust according to the cap in your market on the product every single year after that. Now, currently we're sitting at 5.26. That is 0.13% better pricing than yesterday, 0.01% increase from 1 week ago, 0.31% increase from 1 month ago, and 2.14% increase from 1 year ago. 15-year fix is going to be sitting at 4.75. That is 0.07% better pricing than yesterday, 0.21% increase from 1 week ago, 0.53% increase from 1 month ago, and 2.20% increase from 1 year ago. 30-year FHA will be sitting at 4.90%. That is 0.10% better pricing than yesterday, 0.11% increase from 1 week ago, 0.45% increase from 1 month ago, and 2.28% increase from 1 year ago. 30-year jumbo will be sitting at 4.52%. That is 0.1% better pricing than yesterday, 0.12% increase from 1 week ago, 0.32% increase from 1 month ago, and 1.32% increase from 1 year ago. 5/1 adjustable rate mortgage is going to be sitting at 4.19%. That is 0.11% better pricing than yesterday, 0.16% increase from 1 week ago, 0.24% increase from 1 month ago, and 1.74% increase from 1 year ago. That is going to be the mortgage rate update for 425 2022. Now what's going on in the world of real estate? Now, fee processing, sales, layoffs, wholesalers are stopping locks, rate drops and growth falters. These are all things that are taken in factors. Now, as everybody knows, there's been massive amount of companies, mortgage companies, that have been doing layoffs. Now, one of the biggest ones, which was the most controversial one that has happened, was of course the Better.com little fiasco where that guy, the CEO of the company, ended up laying off 900 people via Zoom calls. Now, there was this really funny article with Rob Christman, which was with who wrote an article that said, I'd listen to their forecasts as much as I'd like to listen to Aerosmith's Steven Tyler dispense advice on monogamy. Now, that was pretty funny. Regardless of who you use, this LO was talking about predictions are a dicey business. Thank you, Julie Roberts, who sent why so many COVID predictions were wrong. We all knew rates would move up higher, but not at this pace. And companies have reacted. Layoffs, reductions, enforced cutbacks, whatever the political correct term is these days, are not confined to lenders. Blend made headlines last week with its layoffs. Resumes for those displaced can be posted here for free. The drop in the volume has allowed companies to focus on cutting costs and maximizing hedging performance on secondary market. Now, what does that ultimately? That just means that, we have been taking a big hit as far as myself is concerned too. Mortgage companies, we have had to go ahead and adjust to the current market because yes, rates have increased way faster than what we were told. Now, everything has been increasing way faster than what we were told. Inflation is taking a really, a grasp on everybody right now, and especially in the housing and mortgaging industry. Now, what has been going on with rate locks? Rate locks have been becoming a big issue where rate locks are not really being honored right now. That's a really big problem. Rate locks are not being honored because the interest rates have been increasing so much that it's kind of been wholesalers, depository institutions, a lot of people for some reason, and it's not on the 30-day locks, it's more on the extended rate and shop locks. So what is a rate and shop lock? A rate and shop lock is just something where you could go ahead and hedge out your total interest rate. Let's say 3 months, 6 months, you could even go as far as a year on some of these rate locks. Now, if you purchased a rate lock, let's say in let's just say August, and you did a year rate lock, that is going to go ahead and hedge you at, let's say last August, you could have gotten into the 3 still. Now we're into the 5, so what a lot of wholesalers, a lot of companies are doing is they're going ahead and just not honoring the lock. They're dropping it because the interest rates have increased, which is putting a negative burden on their books. Now, another really big thing that's happened is there's certain wholesalers, especially for us as mortgage brokers, that wholesalers are not accepting applications. Now, as of effective April 22nd, one of the biggest wholesalers that we have is actually called PCF Wholesale, which is no longer accepting any wholesale submissions for any new rate lock requests until further notice. So they have completely stopped, they shut down on the wholesale side of things. They're not accepting any applications, they're not accepting anything until there comes a little bit of a medium inside of the mortgage rates. PCF Wholesale will continue to honor all current interest rate lock commitments in the wholesale channel and will continue to process and fund locked loans currently in the wholesale pipeline in accordance with our current lock policy. Ultimately, as far as the wholesale channel goes for this, now what we have noticed is here is boots on the ground is that majority of wholesalers right now are going into what's called the non-qualified mortgage. They're kind of expanding their whole entire portfolio because, well, let's just say for the sake of argument that, you know, the conventional route is taking a huge hit. The debt to income ratio on most of these new purchase loans, refinances or anything that goes, it's kind of dwindled away, but you want to still stay competitive. And when you want to stay competitive, it actually you have to dabble into the non-qualified mortgage by going into the sixes, which is the sixes, if you don't know, it's an adjustable rate mortgage. Now, adjustable rate mortgage loans are ones that you could actually, let's say you could do a 7/6, you could do a 10/6, you could do whatever it is. Even some have 8/6s. Now that means that it's going to stay fixed interest only for 8 years and then adjust. The rates will go ahead and adjust to the current market rate after that 8 years, and then it'll adjust every 6 months after that. Now, adjustable rate mortgage is good as long as you know how to go ahead and work around it. Make sure that you refinance out of it every so often, especially when your cap is coming up, and then or when your interest only is coming up, and then you go into a new product every time after that. But sometimes if housing prices do decrease, the chances of you actually being able to refinance out of that will become very, very difficult. Well, if you haven't remembered, 2008 was a really, really big one of them. But if we're selling a lot of 8-1 mortgages right now, the anticipation of the interest rates or the adjustments coming up it's going to be a long time from now, so it's not really going to happen anytime soon. But housing prices will tend to decrease once we figure out that, you know, people cannot afford the homes anymore because the debt to income is so much. Now, the example that I always give is, like, let's say for instance somebody is making $120,000 a year. That's $10,000 a month after taxes and everything goes relatively. Let's just go ahead and say that you're bringing in $7,000 a month. You go get yourself here in the state of California, it's a little bit more expensive, but respectively, let's go ahead and say it's between $700,000 and $800,000. That's the home price that you're going to be purchasing. $700,000 and $800,000 after your down payment. Let's say you do 10%, you do 20%, whatever it might be. You're somewhere in the neck of the woods of between a $4,000 and a $4,500 mortgage payment. Now, if you take that into consideration, let's just say it's $4,000, that leaves you $3,000 left. $3,000 left is not much money to go ahead and live your everyday normal life, especially when you have utilities, you have maintenance costs, you have, you know, car payments, credit cards, you have vacations you want to take, you have, you know, if you have kids, then you have expenses that you have with kids. But yeah, that's going to be our mortgage rate update. That is going to be what's going on in the world of real estate right now. And if you like the content, like, subscribe, comment. If you need any mortgaging assistance, link in the description below. Up to 50% commission rebate on buying your next home, or 0% listing fee on selling your current home. Link in the description below. Until next video, guys, I really appreciate you watching.
As we dance, as we dance. Yes, we dance.